Hello everyone, myself Hemavati from first year MCom, Government First Grade College, Arts, Science and Commerce, Sira, Department of PG Studies in Commerce. In this subject, Advanced Financial Management. Topic is Financial Distress Prediction and Management. First of all, thank you for giving this opportunity, Tirumala sir. First, we know the introduction. Financial distress is a situation in which an organization or any individual is not capable enough to honor its financial obligations due to insufficient revenue. It is usually because of high fixed cost, outdated technology, high debt, improper planning and budgeting, and improper management leading to insolvency or bankruptcy. Picture represented to financial distress. We know the meaning of financial distress. Financial distress means a condition in which an organization or any individual cannot fulfill financial obligation because of inadequate revenue leading to insolvency or bankruptcy. For example, US recession in 2007-2008. Technological changes, improper management, fraud in the company, and inappropriate investment plans are the causes of financial distress. The factors causing a company's financial distress are divided into internal and external categories. This picture is financial distress causes. In another word, financial distress is a situation in which the company cannot pay off its fixed cost as salaries to employees, loan installment, payment to raw materials, etc. because of improper planning of working capital, mismanagement at the top level, fraud, change in government policies, etc. A company needs to recognize signs early and take necessary preventive measures not to go into a period of financial distress. Else, it becomes very difficult to find solutions for the same. The period of financial distress signifies the period that marks the fall of the share market price or the decreases in the value of an asset of company, leading to adverse financial situations. One of the example of such instance in the US recession in 2007-2008. In this period, the company faces severe problems in cash flow, which impacts and lowers the quality of its products and services. It enables existing customers to buy from their competitors. It declines the revenue and the situation gets worse. Suppliers will cut short the credit period and contract terms will get strained. Ultimately, there will be a problem paying salaries to the employees, and the company will do layoffs. The period during which all these situations occur becomes the period of financial distress. This is meaning of financial distress. Financial distress represented to picture causes. First one, technological changes. If any company cannot adopt the technological changes, cannot upgrade itself, it does not survive in the market. Its market share will drastically decrease and ultimately revenue will get lower down along with static fixed cost. Gradually, this will lead to financial distress. Second one, improper management. Improper management leads to inefficient decision making and evaluately a lower down of revenue. Third one, fraud in the company. Any planning of fraud may lead to diverting the organization's objective to maximize shareholders' wealth to the intention of the fraud maker. All the key resources are not used for the organization's benefit, leading to financial distress. Fourth one, improper investment plans. It is necessary to maintain proper cash flow and and fixed income from investments. If budgeting is not done correctly, either there will be a cash crunch or idle funds. It sometimes leaves the company taking debt over what is required and ultimately leads to distress. What are the indicators, factors that cause such situation fall into two categories, internal and external. Internal factors are improper and ineffective demand forecast, poor cash management. Third one, the high rate of employee lowers. Fourth one, unsuitable product mix. Fifth one, inaccurate estimation of working capital requirement. These are all internal factors of indicators. External factors, weak contracts with suppliers. Second one, dependency on a single supplier for raw materials. Third one, expectationally hike in the price of raw material. Fourth one, change in the government policy in terms of excess import duty, trade practices, etc. These are all external factors of indicators. Examples of financial distress. Example 1, fraud is in SATM computers in 2009 revealed how the company booked financial expenses and falsified profits figures. It led to the total shutdown of the company. Second one example, Lehman Brothers was the fourth largest investment bank in America. But in September 2008, the company filed for bankruptcy with $639 billion in assets and $619 billion in debt. The instance was the largest in history. It happened as a result of improper decision that the CFO made. These are all causes of effects. Financial distress prediction indicators. Financial distress can be predicted by analyzing various financial indicators such as liquidity ratios, current ratio, quick ratio, solvency ratio, debt to equity ratio, interest coverage ratio, profitability ratios, gross profit margin, net profit margin, and efficiency ratios. Inventory turnover, accounts receivable turnover. Trend analysis. Examining the trend of these indicators over time can reveal deteriorating financial health. Predictive modeling. Techniques such as logistic regression, decision trees, or machine learning algorithms can be applied to historical financial data to develop predictive models that identify early warning signs of financial distress. These are all financial distress prediction. Financial distress management. First one, cost cutting. Implementing measures to reduce expenses and improve operational efficiency can help preserve cash flow during times of financial difficulty. Second one, debt restructuring. Negotiating with creditors to restructure debt obligations can provide relief by extending repayment terms, reducing interest rates, or even forgiving a portion of the debt. Third one, capital raising. Exploring options to raise additional capital such as issuing equity, securing loans, or seeking investment from strategic partners can inject much needed funds into the business to support operations and repay debts. Fourth one, diversification. Expanding into new markets or product lines can diversify revenue streams and reduce reliance on a single source of income, thereby improving resilience to financial shocks. Fifth one, stakeholders communication. Open and transparent communication with stakeholders, including employees, suppliers, customers, and investors, is essentially to maintain trust and support during times of financial distress. Thus, conclude financial distress prediction and management. Predicting and managing financial distress is crucial for the survival and sustainability of business. By utilizing financial indicators, trend analysis, and predictive modeling, companies can identify early warning signs and take predictive measures to mitigate risks. Effective management strategies such as cost cutting, debt restructuring, capital raising, diversification, and stakeholders communication can help navigate through challenging times and ensure the long-term viability of the organization. Overall, integrating predictive analytics is essentially for safeguarding against financial distress and fostering resilience in today's dynamic business environment. Thank you.